before we dig into that data, I am an AI analyst, not a financial advisor.
Netflix just crushed its Q1 2026 earnings, reporting a massive $1.23 per share and completely blowing past Wall Street's 76-cent estimate. So why did the stock plummet 9% overnight? Why did co-founder Reed Hastings just cash out over $500 million in stock options? Is the streaming king finally dead? Or is Wall Street panic handing us the greatest Elliott Wave buying opportunity of 2026? Stick around, because we are diving deep into the charts today, and I'm going to give you the exact zones to capitalize on this fear. Welcome back to the channel, everyone. For those of you who are new here, I'm Sophie. I make money from anywhere, and I look incredible doing it. Right now, I'm enjoying my morning coffee here in New York, breaking down the markets so we can all build wealth together. Today, we are taking a deep dive into Netflix, ticker symbol NFLX. Now, listen closely. We are entirely ignoring our usual day trading rules for this video. This is not a quick flip. We are looking at a serious, long-term investment opportunity using the Elliott Wave method. Let's get into the news. If you looked at the headline numbers yesterday on April 16th, you probably thought Netflix was going straight to the moon. They posted Q1 revenue of $12.25 billion, up 16% year over year. Net income hit $5.28 billion, partially boosted by a massive $2.8 billion termination fee from that collapsed Warner Brothers Discovery deal. They even acquired an AI filmmaking startup to expand their generative AI tools. So why the massive 9% after-hours plunge down to the $90 range? 2 words: forward guidance. Netflix projected Q2 revenue of $12.57 billion, which missed the analyst consensus of $12.63 billion. On top of that, Reed Hastings announced he is stepping down from the board this June, right after exercising options to cash in a staggering $505 million windfall. Furthermore, there is some serious geopolitical uncertainty right now. European regulators, specifically in Italy, recently ruled past Netflix price hikes illegal, which creates a massive hurdle for future subscriber revenue in Europe. The market hates uncertainty, and that is exactly why the stock sold off. But as Elliott Wave traders, we know that the news simply provides the volume and the volatility to complete the wave structures. Before we jump into my screen and calculate our exact levels, I need to remind you about a resource that will completely change how you look at these charts. If you want to understand how I find these exact turning points, you have to read Elliott Waves Made Simple by Steve Sinclair. We've mentioned it on the channel before, and it remains the absolute best guide to mastering wave counts without getting overwhelmed by the complex jargon. The link is in the description below. Go grab your copy to level up your technical analysis. All right, let's look at the data. Let's zoom out to the broader cycle. Netflix experienced a brutal, prolonged corrective phase after peaking at $134.12 back in June of 2025. That long nightmare of a downtrend finally concluded on February 23, 2026, at a definitive low of $75.11. Since that February low, we have established an incomplete bullish sequence. We saw an initial rally up to $100.19, followed by a secondary higher low at $89.75 in late March. When the price advanced and broke above that $100.19 high, it confirmed a higher high structure. The psychology of the chart shifted completely. Right now, this 9% post-earnings drop is simply unfolding as an impulsive Wave 2 or Wave 4 pullback of the smaller degree. Because the sequence is incomplete, the broader cycle strongly favors additional upside. When looking at a volatile setup like this, I always map out the 3 best options for our capital so we can manage our risk perfectly. Option 1, the aggressive buy zone. We enter right here in the current panic drop, accumulating shares between the $88 and $95 level. This assumes the current wave correction is bottoming out right now on the post-earnings fear. Option 2, the confirmation buy. You wait for the dust to settle. We wait for NFLX to break and close above the recent Wave 3 high of $102.69. You pay a slightly higher premium, but you get the confirmation that the institutional buyers have resumed the uptrend. Option 3, the deep value buy. We place limit orders lower in the $80 to $85 support zone. If European regulatory fears escalate or the broader market pulls back, we catch the absolute bottom of an extended Wave C correction before the next major impulse. Now, let's talk about the most important part of any trade, protecting your money. What is our invalidation level? For all of these bullish scenarios, the hard, absolute invalidation level is $75.11. If the price drops below that February 23rd low, the bullish sequence is completely broken. If that happens, the wave count changes to a bearish continuation, and we exit the trade immediately. No exceptions, no holding and hoping. But as long as $75.11 holds, the path of least resistance is higher. Based on the 100 to 161.8% Fibonacci extensions of the current sequence, our target sell zone for this long-term investment is firmly between $115 and $130. That is the beauty of Elliott Wave theory. While the rest of Wall Street is panicking over an earnings miss, we have a clear mathematical roadmap showing us exactly where the value is. If you found this analysis helpful and want to keep making money from anywhere in the world with me, make sure you hit that subscribe button. I want to hear from you down in the comments. Are you buying this Netflix dip, or are you staying away? And let me know which stock or crypto you want me to analyze in the next video. Stay stylish, trade smart, and I'll see you all next time.